Hey, good afternoon, everyone. My name is John Jimenad, EVP of Production here at Angel Oak Mortgage Solutions. Thank you for joining us today. We're going to do a deep dive into our debt service coverage ratio program today. We'll give everyone a couple minutes to log in. Just some housekeeping stuff. This is being recorded. Every question that comes in, we're going to try to answer all your questions. If we don't get to it, we will have your account executive reach out to you no later than tomorrow to get your question answered. This recording will go out no later than tomorrow. And everything we're going to do here, this isn't a PowerPoint. This isn't a pre-can. This is live. So we've already had a couple of technical difficulties. So this is live, and everything we're doing is from our website. So today we're going to talk to you about our debt service coverage ratio, and if time permits, we'll talk a little bit about our foreign national program, which sits under the same platform as our debt service coverage ratio. We're going to show you how to get rates 24/7. You have access to that. You don't need credentials. And then we're going to really talk to you about how to market for these programs that we have. And we have a great marketing platform that costs, Oscar, how much does it cost them?
Zero.
Zero, right? So there we go. So give it about another 30 seconds. We'll continue to have people log in, and then I'll introduce our two subject matter experts, and we'll dive into the webinar today. Hopefully everyone's having a great August. Really excited about the rest of the year. Traditionally we close, 40 to 45% of our business in the last 4 months. So I know that's counterintuitive to a lot of the conventional stuff out there, but really, really excited about Angel Oak in the non-QM space for the rest of the year and definitely into 2026. So, all right, guys. Well, let's get started here. Again, my name is John Jimenad, EVP of Production here at Angel Oak Mortgage.
Can you hear me? Can you hear me, John?
Yes, Tom, you're live.
I can hear you. I can't hear John though.
Nope.
Hey everybody, looks like we've just had some technical difficulties, so I'm gonna take over really quickly and formally introduce myself. My name is Oscar Ungo. I'm an account executive with Angel Oak. I've been here for 8 years, and I'm down in the South Florida region, and always looking forward to discussing the debt service coverage ratio program. Tom, you want to introduce yourself?
You bet. Thanks, Oscar. Tom Perry here. I'm an account executive here in Dallas, Texas, and I've been here for a little over 3.5 years. Been in wholesale for over 35. So, we've all got some great experience to throw your way.
Can you guys hear me at all?
Yes, we can.
John, there you are.
There you
Oh,
are.
okay. Sorry about that. Again, this is live, so I apologize for that. So we're going to jump into the debt service coverage ratio, but before we do, we're going to launch a poll. So if you guys could launch the poll is, have you originated a debt service coverage ratio alone in the last 12 months? So while we're doing that, hopefully you guys can hear me still, and we'll take a couple minutes there to launch that poll. Okay, so please vote if you've originated a debt service coverage ratio loan in the last 12 months. So appreciate your participation in here. Guys, debt service coverage ratio loans are our number one unit program here at Angel Oak Mortgage Solutions. So, and it seems like that seasoned investor, it's for the first time investor, but for that seasoned investor, it's really a great program. So, all right. So 60% of you on this call have originated a debt service coverage ratio in the last 12 months. So really appreciate you guys participating. We're going to do a deep dive. I mean, you're probably going to learn more. You could probably, by the end of this call, you should be an AE here at Angel Oak Mortgage Solutions. So, Oscar, let's get started here, and let me move a few things around. Oscar, please give us some highlights of the debt service coverage ratio.
Absolutely. So really what today we're discussing is unlocking buying potential for your clients when they want to purchase an investment property, because for those of you who have not done a debt service coverage ratio loan, this is a no DTI program. For those of you who have, thank you for coming back. Welcome back. We're going to go over some other enhancements that we've had over the last few months. We've definitely opened up a lot of flexibility so that you can close more loans. So I'm going to get started really quickly, and I'm just going to go over the fundamentals of the program first for those of you who have not done a DSCR loan before. DSCR is replacing DTI. There is no personal income verification or employment verification on the program. This is why it is opening up buying potential for those of your customers that want to buy investment properties but don't qualify because of DTI. The key pillars of the program: you want to make sure that your client has mortgage experience. So they have mortgage history, or they may have a free and clear property already, that they have the credit. And as you can see, the minimum credit score on the program is a 680. And then last but not least, we want to see the DSCR. And so the way that we calculate that, so how that's determined, there are two ways of determining it. You have clients who have annual rent, and you also have customers that go for short-term rent. So there are two different streams of income. And first, I'm going to use examples of a purchase. If you have a client who wants to buy a property using annual rent, we are going to verify that by using the rent schedule on the appraisal. It's fine that the subject property be vacant, but we're going to use the rent schedule on the appraisal, and we're going to use the average market rent, and we're going to divide it by the total housing payment. But we also have the opportunity, and this is a big opportunity, to use short-term rent. I'm sure that you have plenty of customers, for those of you that are returning, that have done DSCR loans, who look to purchase an investment property, not to rent it out with a 12-month lease, but potentially place it on Airbnb or Vrbo and collect short-term rent. We also offer that option as well, going up to 75 LTV. And that is determined using what's called a property earnings potential report. And I absolutely love the AirDNA feature. Okay, we use something called AirDNA. It's a service it's a third-party company, but service that we offer, and you can actually set yourself up with credentials by going to airdna.co if you like. But really, all you need to do is send your AE the address. We will pull that report, and it absolutely puts you in the driver's seat, because unlike when you're using annual rent and you have to wait on the appraiser's opinion of the market rent, we will pull that report, and we are going to use 100% of the projected revenue on the AirDNA report. You just divide that by 12, and that's what your monthly income is. So you know exactly where your debt service coverage ratio is going to land. You're just going to take that monthly income and divide it by the total housing payment, and that determines what your DSCR is. To put it simply, If your average market rent is 1,000 and your total housing payment is 1,000, that means that you have a break-even ratio of 1.0. And most of us say that this is a nearly bulletproof program because even if you don't have a break-even or positive cash flow, you can actually we will actually move forward with negative cash flow too, as long as your client has the assets for it and as long as they have the credit for it. So those are the pillars of the program. I'm going to go over a few details of the product. Huge niche here. We go up to 85 LTV with a 720 FICO score. We see tons of potential there with 2 to 4 unit properties. That's 15% down. Again, no income or employment on a multi-unit property. Loan amounts go up to 3 million. The minimum loan amount on the program is 100,000. I did give examples on how we calculate purchase scenarios, but refis also put you in the driver's seat too. And we see a lot of those, cash out refis and rate and term. For those loans, all you need to do is ask your client, how much are you currently renting your property for? Take that rent, divide it by the total housing payment, and you can calculate your DSCR. We're going to use the current rent on a refi. And we also have the option of using short-term rent as well. You're just going to want to ask your client for the last 12 months transaction history of the Airbnb or VRBO report. We'll divide that by 12, and that's what their monthly income is too, without taking a haircut. Now, we see many of these loans from the same borrower at once, especially on refis. You will see multiple loans from one borrower, sometimes at once. And for that reason, even though if you're looking over the program highlights that are on the screen right now, it says max of 5 loans with Angel Oak, we will actually make exceptions to go over that. And I'm sure Tom, just like me, we've both had scenarios where we've helped our loan officers get exceptions for greater than 5 loans for one borrower. So just because you see that guideline, make sure that you don't say no to that client. Reach out to us, and we will ask for that exception. Normally, what we find is that on purchases, you're going to have very loyal customers on debt service coverage ratio loans that are going to be buying multiple times throughout the year. So it's very common to see the same borrower on multiple loans and return customers. We have no limit on the total number of financed properties. The program is not meant for first-time home buyers. So there's a clear distinction between a first-time home buyer and a first-time investor. I'm sure Tom, like myself, we get that question often. Is it okay if the borrower is a first-time investor? Yes, as long as they have a primary residence or other investment, as long as they have a primary residence, then yes, they can buy their first investment property using the debt service coverage ratio loan. But it is not meant for someone who's buying their first property.
Yeah,
Oscar, I will also say I've been able to get exceptions, and we'll talk about exceptions later, I'm sure. But a lot of times when you find somebody that's in a rental market, it's a heavy rent market, and they're buying rental properties and they're leasing themselves, that's okay. Or if you have a buyer that has other rental properties, I've been able to get those approved as well. So just because they're not a first-time home buyer, if they've got other properties already, please call your account executive, because that may be something we can make an exception on.
Yep.
Yeah, Tom, that's a great point. Oscar, I'm just going to put you on hold there. So we went over some of the highlights here. We already have a lot of great questions coming in. So, but before we get to these questions, Oscar's given us a lot of highlights of the program, and some of these questions coming in, we'll dive into. Tom, talk about, Oscar touched on it in the beginning about, no income, no job. Go into a little bit more depth on the 1003 and the credit report, please. What you as an
Sure.
account executive are going to look at.
Right. So, when you're putting together your 1003, it's very simple. First, let's make sure your 1003 is accurate and complete, because Oscar and I are approving your loan based upon your 1003. Mm-hmm. So make sure that you don't make sure you got everything in there. Now, you can leave off income, you can leave off employment, and neither one of those are needed on there because we're not using either to be able to qualify. When it comes to real estate owned, make sure that any property that you have that's financed, that's showing up on a credit report, is on your 1003 in your REO section, as well as their primary residence and the subject property, obviously. But the 1003, You can even leave off your liabilities if you want. We're not even calculating any DTI with liabilities. So just make sure you've got the income and employment taken off, and that REO section is complete and accurate.
Yeah. Yeah. Thanks, Tom. And then for trade lines, I mean, we're really not, what are we looking for trade lines on the credit report, right? We know
Sure.
what scores we need, but what are the trade lines?
Right, right. We're looking for two trade lines of 24 months or more, or we're looking for three with 12 months or more.
Yeah.
And that is our minimum trade line requirement.
Yeah, and you heard Tom, you know, we're really not asking for much on the 1003, the loan application, but, you know, anything other than job and income, you know, let's put a little time into it because, basically Tom and Oscar and all our account executives across the country are basically pre-underwriting that file. So, and this is a pretty easy, not taking anything away from you guys, but this is a pretty easy prequel to do up front. So, Oscar, I know you mentioned the 85 LTV. There was a question here. Let me go back. Anthony's asking, we can do an 85% on multi as well, or is that just a single unit, Oscar?
We can do it on multi-unit as well, up to 4 units.
Nice. So, and Oscar, I'll ask on top of that, does that 85% have mortgage insurance on it?
It does not.
Yeah, great. So, all right. So, Oscar, anything else on the highlights you wanted to cover? I apologize for getting Tom in there. So,
Oh, no, that's all right. Hey, highlights on, yeah, you're going to get plenty of customers. And one of the questions that you definitely want to ask your client up front, you're going to see many of investors who will already have rental experience or rental property management experience. And many of them want to already vest in a corporation. So that's a question that you definitely want to ask. We can vest title in an LLC, an S Corp, C Corp, or revocable trust. You just want to get with your client and make sure if they are sole owner or if there are partners, and then get with your AE on how to structure that loan.
yeah. So, Tom, do we have any issue with how many? Sorry, guys, I guess something's going on outside. Do we have any issues how many properties that borrower has financed?
No, we don't have a problem with that at all. They can own as many properties and finance as many properties as they want. We just have a limitation to the number that we will finance, and we talked about that earlier.
Yeah, yeah. And then Oscar, how quick, we'll talk about how to submit a prequel to us here in a minute or in a few minutes. But how quickly can you or Tom really? How quickly can you guys turn a prequel on this?
10 to 15 minutes, as long as, like Tom said, you get us the very little that we need on a 1003 and a credit report. And then realistically, if you get that to us same day, we do have other loans that we have to look at, but if you get that early enough in the day, realistically today, you can actually have that loan pre-qualified and potentially have a conditional approval, pre-qualified conditional approval within about 2 business days with our new self-disclose, auto disclose feature, and then auto submit to underwriting feature. So these loans are moving extremely fast.
They are, Oscar, and I'm glad you brought up that self-disclosure. Great point there, Tom. So on a prequel, Tom, can you do, if it's a purchase, can you do a prequel for a TBD property, to be determined?
Certainly, you bet. Do them all the time. So let's say your borrower's out, shopping with confidence that they've got an approval on it.
Yeah, Tom, and that's, we're, the more I'm finding out, we're one of the only non-QM lenders out there that do prequels up front, right? So, and our pull through on these are extremely, extremely high. So, Oscar, some other questions here coming in. On a cash out refi where the property is recently vacant, can we use long-term rental income on the 1007? And I know this is kind of a got to navigate your way through this question, but go ahead, Oscar.
Yeah, so there are plenty of scenarios that we look at where we just use common sense underwriting and we say, well, look, if there are plenty of times when a borrower, where we see that a borrower has purchased a property, They've owned it. They've possibly already had annual tenants in it. Those tenants have exited. They decided that they wanted to remodel the property, and so they're done remodeling the property. In those scenarios, we have about a 60 to 90-day window where we're fine, where we can just use the market rent on a cash out. Yes.
Yeah, and then Tom, talk about gift funds, Tom. This is something we added about, I think, about a year ago, maybe longer. Time's flying, but do we allow gift funds?
We do. We allow gift funds as long as the borrower has their minimum down payment into the property and has reserves of their own funds. So yes, gift funds are allowed.
Yeah, and then really on top of that, Tom, just talk about what we recently upped or the seller concessions.
Oh yeah, seller concessions. We're 6% on seller concessions. So that, and I think that's really overlooked a lot of times. A great 6% seller concessions is more than Fannie and Freddie at 2%. That's a great thing to do. But how can you use that whenever you're going out and helping your borrowers and your realtors negotiate properties? Here's what you want to keep in mind. Let's say somebody does want an 85% LTV. You have to have a 1-to-1 ratio or higher to be getting an 85% LTV. With the market rates where they are now and the increase in pricing in properties, is difficult to get that 1-to-1 ratio at these days and times. So what I suggest my customers to do is to go out and negotiate a seller concession instead of negotiating the lower price on the house. Use your 6% seller concession to buy down your interest rate. You're going to cash flow much better than by getting your rate lower than lowering your sales price by the 6%. So that is a great way to get your 85% LTVs approved, because you have to have that 1-to-1 ratio. And then on all the other LTVs, your 80% or less, some of those still are not cash flowing. You're going to have to drop into that 80 to 0.99, 0.8 to 0.99 bucket, which is going to cost you a lower LTV and a higher interest rate. So use those seller concessions to buy down the interest rate to make sure you've got your 1-to-1 ratio to make all the programs work to the best of the ability.
Yeah, thanks, Tom. I appreciate that. Oscar, Tessa's asking about rural properties. So
That's a great question, and I'm glad you asked. Rural properties. Well, the immediate response that I have is, will there be comps? If we have comps, then we actually see that plenty of times, especially when someone's looking to buy the property for the use of short-term rent. And so we can use AirDNA for that. But there do have to be comps. Many times when we do see quote unquote rural properties, they're in vacation markets. And so, they may be in markets where you see plenty of people that go there to ski, beach towns, etc.
yeah. And Jenna, yes, Jenna had to jump off our call. So this is just housekeeping. If you didn't hear me in the beginning, because I had some audio issues. This is being recorded. We will get the recording out to you by end of day tomorrow. So Jenna, go take care of your business. Appreciate you joining us. A couple other questions here. Tom, do we allow, and I hate asking questions I already know, do we allow mixed use properties, Tom?
Oh gosh, I haven't had one of those in quite some time. I believe that we will. Oscar, you might want to jump in on that one. I haven't had a mixed use.
Yeah, so mixed use we don't lend on, so the property can't be commercial or mixed use. It has to be strictly residential. But something that Tom mentioned that I just struck a light bulb, because I'm sure that he's gotten this feedback and I've gotten this feedback too. This is unrelated to the mixed use property question. On rates, we're seeing a lot of customers who will price out a debt service coverage ratio loan and call us and tell us that our rates are extremely competitively priced, especially compared to your agency loans, where the rate and the total costs are actually less. So, and that's in certain FICO and LTV buckets. So you definitely want to price those out, because at the end of the day, there's a lot less documentation for a debt service coverage ratio loan.
Yeah, great point. Great point, Oscar. Tom, talk about prepayment penalties, please.
Sure. Prepayment penalties are required on this loan. You do have an option of 0 to 5 years. Whenever you price out on our pricing engine, which you'll see pretty soon if we do a DSCR loan, the pricing engine will default to a 3-year prepay. Now, these prepays are per state, so some states will allow higher prepays or no prepays at all. So please check with your AE on those. But it will do a default to 3 years. You can change that to the 5 or change it to a 0. And the pricing will be reflective of those years of prepayment penalty.
Okay. So Oscar, Sandra's asking, and we have this here, and maybe this will help. Sandra's asking, what do we mean by a 1-to-1 ratio? So Oscar, if you want to go back through and talk about the examples that we have here about a 1-to-1, a 1-to-1.0, and even talk about, it's going to take you a few minutes here, Oscar, even talk about the no ratio, please.
Absolutely. 1-to-1 really just means that the rent equals the exact PITI or PITIA. That's simple, because we're just dividing. The way that we're calculating the DSCR is by dividing the rent. So if it's a purchase, we're going with market rent on the appraisal. If it's a refi, it's going to be current rent. So you're just going to divide the rent by the PITI or PITIA. And 1-to-1 means that they equal each other. Now, if you have, let's say, if someone says 1.20, that just means that the rent is 20% greater than the housing payment. And if you have a ratio that is 0.0, so you're less than 1, that's negative cash flow, that means that the rent is only 80% of the total housing payment. Just regardless of what the ratio is, if your client has the assets, if they have the credit, we have a loan for them. So that's the beauty of this program, is how that you do have the ability to structure the loan and your client can get financing. So when we mean no DSCR, we mean a ratio that's less than 0.8. So just to give you a numerical example, the rent is $800 and your total housing payment's $1,000. That's 0.8. We can actually do that loan. But let's say that it's less than that. Can we do that loan? Yes, we can. On a purchase, we'll do that at 70 LTV. And then on a refi, we will do that at 65.
Yeah. Yeah, thank you, Oscar. And we even have a calculator here for you. So, with the monthly rent, the loan amount, taxes, interest rate, monthly insurance, we have that all here for you. So if you get that information from your account executive, you can easily come here and plug that in and play with that for a little while. Tom, another question here. Can we use a 1031 exchange on this program?
Yes, you can use 1031 exchange funds. So just let your AE know that you have those, and they'll give you the guidelines to meet to be able to use those funds.
Yeah. So what we talked about rural here. I have a borrower that paid her house off in July and put it into her single name LLC, preparing to renovate and sell the home. Can you cash out on a property? So basically, can you cash out on a property in an LLC? Oscar, sorry.
We can cash out on a property in an LLC, but we don't have just make sure that the property, it sounds to me like they're cashing out to sell the property. Make sure that they're not selling that property within the prepayment penalty period, if there is one. Connect with your AE on that scenario, because if they don't buy it out completely, there is a prepayment penalty.
Right.
And then, so definitely connect with your AE on that scenario. But yes, we can vest title in LLCs, a corporation, S corp, revocable trust, etc.
Yeah. And some other questions here. We talked about gift funds. So, Tom, talk about the transactions. We've touched on cash out. We've touched on purchase, refis. Talk about delayed financing, Tom, because a lot of times investors like to pounce, right, and get that property.
Right. Yeah, that was just on my mind, John. Thanks for throwing it my way. Delayed financing is available on our DSCR program. So delayed financing would be anything less than 6 months. Our guidelines do say that for a property paid for in cash, it is an exception for us to take a look at something that's using hard money. But we can take a look at those with the right documentation. Now, on a delayed financing, we treat it as a purchase. And we're going to use the appraised value
Yeah, thank you, Tom, and thank you for talking to also expanding into how we can use appraised value after 6 months. So appreciate that. Keep the questions coming in. I told you if we had time, we would talk a little bit about a foreign national. So Oscar, if you want to just because the foreign national sits underneath the debt service coverage ratio, you want to just talk about some highlights of the foreign national program, please?
I do, but a light bulb did go off, something that we didn't cover, which I think is becoming a lot more common across the country. I'm in Florida. It's nearly, I would say, and I'm talking condos, John. So
thank you.
In Florida, about over 60% of the condos are non-warrantable. So if you're in a market that has condos, we do lend on non-warrantable condos. So do not say no if the condo is non-warrantable. Just get the information on what's making the condo non-warrantable, and get with your AE. Okay. So we do lend on non-warrantable condos, and then specifically on the debt service coverage ratio program, we do lend on condo tels. So again, back to the rural question. Well, again, I talked about vacation markets, and we tend to see a lot of condo tels in vacation areas. In Florida, we see it along the Panhandle and those beach markets. Up in the Northeast and in the Midwest, we see in the skiing vacation areas, we see a lot of condo tels. So we do lend on condo tels, and we do use the short-term rental AirDNA report. Again, put you in the driver's seat. Just get with your AE with the address. We will download the report and send you the projected revenue. You'll know exactly how to structure that loan. Okay. So,
yeah, Oscar. So you now another light bulb went off on me when you talked about that, and we'll do that. We'll do that AirDNA at the prequal stage.
Oh, yeah.
Right. And that's a huge benefit to everyone on this call and their borrower. I mean, that's it's going to work up front, right? So
yeah, like Tom said, it's putting you, your customer, at ease. You know what your projected revenue is. You know what your monthly rent is. It isn't a guessing game. So it puts you in the driver's seat of structuring your loan. You can pre-qualify your borrower that way, and we talk about our quick wall. John's mentioned the importance of it, the value of it. Like you, we believe that you should pre-qualify your customer. We're not just submitting loans up to underwriting to see if they stick. We know that your reputation matters, and that's valuable. And so we're going to take a look at your 1003 and credit report. We're going to walk you through the program for those of you who haven't done it before. And then we're going to send you what's called our quick wall. And on that quick wall, you're going to know what you need, the minimum that you need for us to underwrite your loan. And like every program has standard conditions, we're also going to give you a heads up on what those standard conditions are so that you can get ahead of them, and you just go through a streamlined process and everybody walks away happy.
Yeah. And don't forget, Tom has, condo tels in the Gulf Coast down here in Texas too. So don't leave out the Texas.
In South Padre. Absolutely.
I got your back, Tom.
Yeah. Talking streamlining, I mean, the foreign national loan is just a more streamlined version of a debt service coverage ratio loan. We talked about needing credit for the standard debt service coverage ratio loan. We don't need credit for a foreign national loan at all. We're not looking at it. So how do we work this program? It's pretty straightforward. The main difference here is that the DSCR ratio, was it Sandra who asked the question? Here it has to be 1. Okay, so your rent does have to equal your total housing payment for a foreign national. You're going to want to collect your client's visa. That is extremely important. Collect the visa up front. If the country, like Canada, happens to be on the visa waiver program that we don't need the visa, we're just going to ask for the passport unexpired. And there's a difference with the LTV too. It's up to 70%. The reserve requirement is different. On DSCR loans, we only needed 3. On the standard DSCR program, we just needed 3 months. For those foreign national loans, we're not asking for a lot, but we do need 12 months of reserves. They don't need to be moved to a U.S. bank account. Those reserves can stay in the foreign account. And then a really important piece here is just your timeline and the assets. So on a foreign national loan, assets need to be sourced in season for 60 days total. 30 of those days have to be in a US FDIC insured bank account. So the clock starts then. So you want to make sure that your client gets their money into a US FDIC insured bank account. You also want to make sure that they add a little cushion there in case you need to structure your loan. They may need to put a little more down to get the DSCR to 1, especially on a purchase, because on a purchase when you're using annual rent, again, we're waiting on the appraiser's opinion of rent.
And remember, Oscar, use those 6% subtle concessions. You can still do it on a foreign national.
Yep.
Yeah. Great point, Tom. Great point. And Oscar, you hit on the 3 months for the traditional debt service coverage ratio program that we have. And that's just on the subject property. We don't require reserves if they own multiple properties or they're primary or anything like that. It's just on that subject property. So I think that's critical there. And with all the geopolitical strife going on in the world today, we're starting to see an uptick on that foreign national program. And we'll talk about marketing, but so I don't forget about it, we're seeing a lot of foreigners send their children here, and therefore they're buying, around a lot of large universities, that they're buying that house or that condo near that university so that child can go to school there for that 4 or 5 year term, whatever they're going for. So, so a couple other questions. Sorry, let me see what are coming in here. We already answered that. So Sandra's asking, Tom, and you've mentioned this a couple times. I'll throw this question back to you. Sandra's asking, what's Angel Oak's limitation on how many properties they will finance?
Yeah, so they can own as many properties as they want, where there's no limit there, but the properties that we will finance, the guidelines are 5 properties, but we will make exceptions to that. We often do packages of 6, 7, 8, 9, 10 loans. Oscar, I've watched one of his recent videos, and up to 11, I think he's done. So just give us a call. I can't stress enough to start your loan by calling your account executive and running the scenario by them. They're there to help you formulate and structure your file for the best chance of approval. John often calls our pre-qual the AE and originator confessional booth. So I think it's a great way to remind you, this is where we're going to take, if something's not right on your 1003 or it's not, your documentation isn't correct, we're going to ask you to correct it, get it back into us, and we're going to structure that file to give you the best chance of an underwriting approval. So anyway, I kind of got off on topic there, but yeah, we'll do 5 as a guideline and exceptions 10, 11. I'm not sure how many Oscar you've ever done, but 11 is the most I've ever heard.
Yeah, and Tom, and if, just as a public service announcement to everyone out there, if you've got your CRM, your database, whatever you're using, if you've done investment properties with previous customers, we're seeing a lot of cash outs coming in right now on DSCR, and that's because that investor still believes in the greatest way to build wealth in this country is through real estate. So, Oscar, I'll go back to you. You mentioned it. Sandra's asking a lot of great questions. She wants to confirm the reserves can be in that foreign bank. It just needs to be here for the down payment and closing costs, correct?
That's correct. Yeah, the reserves can stay in the foreign bank account.
All right. Cool. Hopefully, Sandra, that, and I'll put I know you guys probably want to, but I'll put a shameless plug in for, we're not going to cover it here today. I see you guys smiling, so I'll throw it over to Tom to see if he knows what I was getting ready to say.
I don't know, DSCR seconds maybe?
Bingo. You read my mind. Go ahead, Tom. We're not going to cover it today, but I can promise you next month we're going to do a deep dive into our HELOC seconds, our closed-end seconds. And Tom, go ahead, take it away with the DSCR, debt service coverage ratio second lien we just rolled out.
Yeah, that's a great product. I can't tell you how many times I've been asked for it. Yes, we will, on our DSCR program, we are doing closed-in second lien only. And that product is available for you. So your investors that have those properties out there, one of the John throws out a lot of I think equity
Oh,
numbers.
yeah.
One of the numbers out there, which is what they call equity rich. There's 47% of the properties in the United States have 50% or more equity. So if they've got one of those low interest rate loans on them and on an investment property, and they want to cash out but don't want to lose that low interest rate loan, this is where that DSCR second is going to come in and help you guys close another loan.
Yeah, Tom, I know Oscar's a numbers guy, right? Oscar loves throwing a lot of these numbers out. 40% of homeowners own their house outright, right? And then, 63, Eric Morganson used it, 63% have rates lower than 4, 85% have rates lower than 6. Even if the Fed starts to drop rates next month, they're still not going to be lower than these rates, right? So that debt service coverage ratio second lien is going to be huge going forward. So, and then, we could talk about the debt that is out there, credit card debt, 24%. There's just a lot out there. But, one of the things that Tom touched on, that I think it's $37 trillion in equity in homes out there. So sorry, Oscar, we're still a little bit of your of your of your thunder there. But guys, we're just trying to give you ways to finish your year strong and to put your plan in place for 2026. So I know we're getting close on time. So Tom, you're going to talk to us how to get rates. You're going to talk to us on how to submit a prequal. So take it away, Tom. Tell me what you need me to do.
Sure. First thing is no credentials are needed. Just go out to our website. We're going to start you want to price a loan, you go to our non-QM quick quote there, that's the second icon. It's going to take you right into our pricing engine. Top is the channel type. So if you're a non-Dell or if you're a broker, please select that. Your pricing for non-Dell will be through your secondary marketing department. But this is where you're going to be able to go in and put in your parameters and get pricing back, and it's going to make adjustments for everything that we have loan level price adjustments for. So just make sure you're entering this data in there correctly. Now then, if you don't get a reply back at the bottom, it says there's no programs available, call your account executive. This may be something that they just need to correct in your input, or it could be something that we need to ask for an exception on. So just make sure you're contacting your account executive and let them guide you through anything that you're not getting a positive result on.
Yeah, Tom, the critical thing here, you can see a list of all of our programs here, is to make sure that the income documentation, you're clicking on that debt service coverage investor cash flow program there.
So you can see there that the prepayment penalty came up for 3 years, as I talked about earlier, as a standard. John, if you click on that, they'll see the options there on the prepayment penalty, anywhere from 0 to 5 on the prepayment penalty.
Yep. Sorry, Tom. There you go.
That's all right. That's all right.
So Tom, it's going to give you some highlights of the program here, right? We requested a 70. Yeah. Go ahead, Tom, if you want to take it. Go ahead.
Yeah, it's going to give you the rate that's closest to par. So if you want to see the rate stack, just click on your view rates there. Also, too, when you're there, John, if your LTV is too high, the program is smart enough to tell you, hey, this is the max LTV, but you've asked for this, and it allows you to make that change or that adjustment, or call your account executive for that exception. But here's the rate stack. You'll see, 6.5% is at par. As a bar, actually, it's paying back $1,000 on this case. It's a quarter premium. As you can tell, these are pretty close to Fannie Freddie agency rates. So,
Tom,
be sure
you're not providing income. You're not providing job information, right? You're not providing lease agreements on all the other properties that you own, right? This is
right.
pretty,
Yeah. No rent roll, no Schedule E, no 75% vacancy and maintenance factors to have to deal with. This just makes it very simple. it's sometimes even if we're an eighth to a quarter more in rate, sometimes it's worth it to your borrower not to have to go out and dig all that information up.
Yeah.
So these are just really great loans to take to your investors.
So Tom, I clicked on the 6.499. Am I
Sure.
locking the loan at this time?
No. If you're clicking on it, this is our next step to be able to go into our pre-qual. So a pre-qual will begin here. So you'll go in and price your loan out and choose your program for us to know what you want to pre-qual with. So click submit. The 3.4 file, you can, if you have it available to use. Some companies don't allow you to produce them. Some do. But if you don't have it, don't worry about it. Just click next, and the next screen is going to be where you're going to put in your account executive there, your company name, you as a loan officer, NMLS number, loan number, email, and borrower information or borrower name. And then your documents that you've prepared, this is where you're going to drag and drop your 1003. You're going to drag and drop your credit report or browse for them, whichever is your pleasure. If you have your 1008, that's great. It's not a required field, as you can see, because it's not red asterisk. Additional documentation can be put in there as well. So feel free to put anything else. But really, I very seldom get additional documentation unless I have talked to a borrower or a broker and they've said, hey, I've got this particular situation and I know I'm going to have to go for an exception on it. I ask for that documentation then. So if you've had a bankruptcy or bankruptcy discharge date or housing event that's been completed, a foreclosure short sale, put those dates in there because that will help us know what's going on with that file as well. Once you put that information in, it takes literally 2 to 3 minutes to do a pre-qual submission. Yep. Click submit. That submit button notifies your account executive. Make sure you choose the right AE, and they will start working on your pre-qual and get you your answer back or call you with questions that they may have.
Yeah, Tom, great way to take us through this. I have to, Anthony. I'm going to Anthony. He didn't ask a question, but he put this in the question box, and it's making me just like go crazy here. Anyone not using this product is losing money in this competitive market, not competing with the big banks or builder lenders. So thank you, Anthony. I appreciate that. So, and then,
nice comment.
Yeah, that's it right out of the ballpark. You're right. The Mortgage Bankers Association was projecting a 16% increase over previous year. Well, non-QM is increasing at 50%. So if you're not doing any non-QM, you're actually losing market share. So thank you, Anthony, for bringing that up. And Jenna's asking, I'd like info on the closed-end seconds, please. We will get that to you. So thank you for bringing that up, Tom. All right, Oscar, let's, we've covered the program. Everyone here should be, pretty well-versed in 1003's credit reports and highlights of our programs. And you guys did a great job answering a lot of questions. Want to be respectful of everyone's time. But this is an exciting part of our website. So let's get started here, and hopefully we don't have any user errors here again, Oscar. So.
And John, while you're doing that, I just want to say, we're showing you guys how to do this, but remember, we know that you are not going to grasp all this and be able to do it perfect. That's the reason why you want to call your account executive, let them walk you through the process. We try to treat everybody like it's their first time, whether it's your first, second, third, or fourth loan, because we know it takes time to be able to get acclimated to a system. And if you only do 1 or 2 loans every other month, it's still hard to get acclimated. So give your AE a call. We'd be glad to walk you through it.
Well said, Tom. Yeah. And Oscar, he's used, jump in the pool. He'll be the lifeguard and take care of you. So these are not hard loans. Everyone's, it's not agency. I lose control. You can see by Tom and Oscar on this call, and all of our account executives across the country are seasoned professionals. And I think the average tenure here at Angel Oak is over 6 years here. So we're going to take care of you. So Oscar, let's talk about marketing. I know you love it. So have at it.
It's the program's like riding a bike. It's we're going to be your training wheels and
I
and
got to
eventually.
introduce, I got to interrupt you one here. That's
Yeah,
another. Mike is asking, I did my first DSCR loan with Angel Oak last week and they closed one in 4 days. From
holy cow.
submission to close in 4 days. Mike,
That's a
love
testimony.
it. Love
Yep.
it. So go ahead, Oscar. Sorry.
So like Tom said, if you have not done a DSCR loan yet, please drop a comment in the comments box so that we can get you in touch with your account executive. And we have, it is not an issue. You don't have to call us and apologize for taking up for getting a minute of our time. That is what we're here for. It's the reason I wake up in the morning. It's what we love to do, right? So we would love to educate you on the program. This way you can start building your pipeline fast. And speaking of getting that done, building that pipeline fast, this is one way to do it. It is by using our marketing portal. You don't need to pay anybody to set up any sort of marketing flyers for you. We have them already done. You're going to ask your AE for credentials. This way you can log into our portal. We'll get you set up with credentials. And plus, if you happen to be on the call and you're not set up with us, I mean, at the moment, we can probably get you set up within a day. It's very quick, very easy. You just have to fill out the application and send it in, and then you'll get your credentials and you can access this portal. So once you're in, this is the landing page. It gives you turn times but this is also where you're going to start adding your loans. But we're going to be talking about the marketing portal now. So you're just going to hover over the marketing portal field, and then we're going to start with presentations. We do, I would say that on a weekly basis, we do educational webinars for you all and your teams, and we would love to continue to do those. But we will also help you educate your networking, your referral sources. And for that reason, we have this realtor presentation that's completely unbranded. All the marketing is completely unbranded. It's just missing your information on it. What I like to do is I will set up a call about 48 hours before the actual presentation with you, and we will go over the presentation and our talking points. This way, it is seamless when we do present. And we're going to teach your referral partners how they can also build their real estate portfolios using the debt service coverage ratio loan. If you're presenting to realtors, we'll teach them how they can present this to their investors.
Hey, Oscar,
Oscar,
Jenna's not here. She's like, I want to do a webinar with my AE. So she's like, she's geeked. She wants to know. I think I know who your AE is, Jenna. But we'll get to you. We'll get that information to you. So,
hey, John.
Yeah.
So on the realtor presentation, I just want to mention one of the questions I ask in my presentations is how many of the realtors in the room know that they've closed a loan with a bank statement loan or a DSCR loan or something that's been non-QM, if they know what that means, because a lot of them don't even know what that means as a realtor. And my feedback is less than 5% of realtors know about these loans. We ask them about what if you can't qualify with taxes, or what if your borrower has too many properties, they can't get another investment property. Those are the questions I ask to find out what they know. Less than 5% of your realtors know. This is information that they need to know. And with this realtor presentation, and I'm sure you're going to talk a little bit more about it, Oscar, we're going to show them how to make more money.
You're going to show them, absolutely. You're going to show them how to make more money. And the exciting part is that, I mean, I'm sure we both had testimony where our customer will come back to us, a loan officer, and will say, hey, I actually walked away with a few loans after that presentation.
Yes.
Yep.
Normally, it's actually a realtor that was on the call that ends up being the borrower on the loan. So
right.
It's a really great presentation. And please reach out
So
to
Oscar,
us. Yeah.
so we talked about the debt service coverage ratio today. So we don't have statistics for how many realtors actually close loans on those because we don't need job and we don't need income information, right? But one thing we do know is on our bank statement program, 9% of the loans we close underneath our bank statement umbrella program, 9% of the loans we close are actually for realtors. And it's exactly what you, Oscar, and Tom have talked about. They don't know about these loans out there exist until Oscar or Tom or any of our other account executives across the country go out and present on your behalf. And Oscar, do you say anything about Angel Oak when you're doing that realtor presentation?
At all. you all are the star of the show. Sometimes I'm introduced as part of the marketing team. Sometimes I am introduced as just an investor. But at the end of the day, it is clear that they need to reach out to you to take the application and structure the loan and speak to the customer.
Yeah,
We're behind the scenes.
yeah. So we go in there. It's like I always joke, we're like in the witness protection program, right? And I just when we go in and present on your behalf, I'm going to go in there. We're going to talk about bank statement program. So when the realtors start to nod their head, say, yeah. So what are you going to do when you get that self-employed borrower? You're going to reach out to Jenna, right? That's who you're going to reach out, or you're going to reach out to Anthony, right? So those are the people we're just going to continue to talk about you. As Oscar said, you're the star of the show. So sorry, I get geeked up on this part of it. So. All right, Oscar. So we talked about the realtor presentation. Want to talk about social media?
Social media is key today in today's market, and so we have social media flyers and social media content developed for you, and it's developed for all of the applications that you can think of. We've for LinkedIn, for Instagram, for Facebook. The dimensions are there specifically for those apps. The you have marketing content for every single program, transaction type. They're very easy to download. You just click and download them. And the great thing is that even if you're not 100% confident about what to write out in a caption, if your target audience is a realtor or a borrower, well, we've already pre-written it for you. So you just really just need to copy and paste. And Tom gave an example on a prior call that I gave, and it makes me think of a scenario. Before we started all this, John asked, what is the cost, right? What is the cost of using these resources? We're not charging you anything, but the absolute cost of not using it, well, lost loans, right? Like, what are you missing out on if you're not using our marketing material? And I'm going to give you an example. I had there was a loan officer, and this was years back already, but he was green in the industry. So his branch manager reached out to me because he specifically said, I see this debt service coverage ratio program as a great resource to get through the door at some real estate offices, just something new. And with that, I had a conversation with the loan officer. I told him about the marketing content. He didn't actually set up a presentation, but what he did do was he downloaded the marketing material and he found a investor group on Facebook, and he posted the flyer on Facebook, and he landed a borrower that needed to do multiple refis. I think it may have been up to 9. So he had never done a loan in his life.
So
And
Tom and I are laughing because we all steal from each other, right?
I've seen you steal it, John. I've seen you steal it.
But Tom, go ahead, Tom. You did a Google search.
Yeah,
Go ahead.
you let me do it this time, huh? Yeah. So, and this is when I first came into Angel Oak, and I thought, what is the marketing? How can I help my customers find the broker? I mean, that's the borrowers. That's always we can provide these programs all day long, but it's about finding your borrowers. So I just went out and Googled investment groups in the Dallas-Fort Worth area, and I counted more than 20 investor groups in Dallas, and I stopped because I thought, well, that's plenty of business to go after. So, I still think that that's a great opportunity. They probably know more about it now, as our survey showed that 60% of you guys have originated a DSCR in the last 12 months. It is a more popular loan, but you take those opportunities and contact those investment groups and let them know you're available.
Yeah, Tom, that's great. I know we're getting near the top of the hour. I want to be respectful of everyone's time. So we also have flyers. Oscar, I'll just touch on that quickly. Let me get back up here. And again, I think I counted one day, there's maybe 70, like if you used every one of our marketing, whether it's a flyer, social media post, the realtor presentation, if there's like 70 times you could use something to post out there. That's your marketing for a year plus if you did it every week. So again, we have flyers out there that you can customize. Where's the debt service coverage for here? We call it investor cash flow internally. But you can put all your contact information out there, and it says nothing about Angel Oak. I put my contact information, and this is actually my real contact information. So I thought I had my phone number saved in there. So if so, that's my email. If anyone.
Yeah, so once you put your information in, it saves it for any other flyer you pull up. So it's real user friendly.
And that's my phone number if anyone wants to. I know we're right at the top of the hour. So, Tom, anything in closing you have to say or need to say? Or
I just want to reiterate: call your account executive. Call your account executive. Ask questions. Let them help you structure these loans for the best chance of approval. They're your best avenue to winning more business.
Oscar?
We talked about unlocking buying potential, and that was, I would say, a lot of the focus. We touched on unlocking equity with your client. This is a great product to do it. We're unlocking equity for those borrowers who don't qualify when they want to cash out on an investment property, and now we have a second option. So I just want to say, join us on the next call where we're going to really focus in and do a deep dive into our seconds and all those opportunities, because we are seeing a mini refi boom.
Yeah. So again, Oscar, Tom, thank you guys for your time and your expertise. And it's really, you guys, you are the reason why we separate ourselves from everyone else out there. So for those of you that have closed, like Mike, closed a loan in 4 days with us, thank you for your business. For those of you that have not, give us the opportunity. We'd love the opportunity to help you close more loans, and as Oscar mentioned, we can start building your pipeline if you start marketing yourself today. So so on behalf of everyone here at Angel Oak, thank you for attending this webinar today. We will get this recording out to you before end of day tomorrow, but thank you very much. I loved a lot of the questions, the feedback. I'm just excited about the rest of the year in 2026. So Oscar, Tom, thank you for joining us. I really appreciate your guys' time.
Yep.
You're welcome, John.
Good afternoon.